With the recent moves that the markets had, be it Tesla, Bitcoin, or today GameStop, it feels like the next 5 seasons of the Showtime show Billions is well covered. Anyway, we can keep talking about it, but we have to get on with our show. Welcome to Market Malts and Machines, and I'm Vikram Gore. In today's show, we have a special guest, and that guest is my friend from high school. His name is Amol. So we got to talking. He saw some of my videos, and he had a couple of very basic questions that he wanted to talk a bit more in depth with. And we figured that a Q&A type forum today might actually help. So today's episode, we're going to focus predominantly on the market side of things, where he'll ask me a few questions, and then we'll have a discussion based on our feedback. Let's take a look as to what our discussion was about. Welcome, Amol. Thanks for joining the episode this time around. It's great to have you, and appreciate the feedback you provided. Like you suggested, and I feel like it's a great time to bring you onto the show and maybe do a Q&A and get some real time perspective.
Hey, thanks, Vikram. It's an honor to be on your show here. It's been super exciting. The last 5 episodes have been interesting, not just for me, but we watch it together as a family and talk about it. So it's been a topic of conversation at our home. But I do have some questions, and I thought it might be best to sort of talk to you live and see your perspectives. Firstly, let's talk about markets. Your thoughts on dollar cost averaging were solid. I love the fact that you emphasize being patient for the compounding to sort of take effect. And I was curious because S&P 500 provides a very good sort of collection of some of the best companies, and it's if you do ETFs and spiders or whatever, it's a great way to get into the market, get the diversification, get the sort of large caps, and get exposed to them. But I was curious, for a average investor like myself, who doesn't have too much time to study the market or study individual stocks, isn't that the great option to just invest in S&P 500 and just dollar cost average over time? Why bother doing anything else? Right?
Yeah.
That was my first thought. Is that good enough for a portfolio? From a long-term durability perspective, is it really that simple?
Yeah.
Or is it 80% of the answer is what I'm looking for?
Yeah, and the short answer is yes, right? It is indeed 80% of the answer. And the funny thing is, so I've been reading this book. It's called How I Invest My Money, and this was written by Brian Portnoy, not related to David Portnoy, if you know who I'm talking about, and Josh. He goes by Downtown Josh Brown, but his name is Josh Brown. He's a money manager, and what they did was they sent messages to their community, and they said, "What would you like to be a part of this book that we'd like to share with everybody how we invest our own money, not our clients' money, our own money." And these are folks who are money managers for high net worth individuals. Okay. And one of the consistent themes for a lot of these money managers was that there are different chapters by different money managers, by the way, that they just believe in simplicity. They believe in picking the right index funds, the lowest cost funds, and sticking with it, putting money into it on an ongoing basis. So these folks who execute some pretty complex strategies for their clients, depending on their risk tolerance and age and whatnot. Mm-hmm. When it comes to their own money, a lot of these, they stick with simplicity. And that's why this is so powerful. And there are three other reasons why it's also very powerful. One is it takes out the emotion in investing in particular, or also trading for that matter. Because sometimes you get emotional or you get scared when the market tanks and then you feel like you want to pull all your money out. Probably the worst time to do that. And other times when you're chasing returns, you see everybody else gaining, 100, 200, 300%, you're chasing them and you want to put money into it at the worst time. So what it does is that it takes out that emotional aspect of investing, and by doing it in a consistently disciplined manner, dollar cost average, like you said, right? So that's the one reason. Second is that most people, if not all people, are not good at timing the market because nobody really knows what the future is. So it takes that piece away from you. Maybe your need to to try out if you can actually try the market to time the market or not. So it kind of takes that away. And by doing these things, it allows you to stay in the market for a long period of time, allowing the compounding to work like you just talked about earlier. So for all those reasons, I mean, that's pretty much 80% of the answer. Now the question becomes, when, if at all, should you, go outside that rule, the norm, and consider something else, right? So there are a couple of reasons why you may want to consider something else. And one of them we saw last year, which is a pandemic that completely upends the usual way of doing business. There were all kinds of closures, and work from home trade became the primary winner. So had you invested very diligently in a disciplined fashion in the SPY, last 12 months, SPY's return is about 16%. So that you would have gotten 16%. But in the same last 12 months, the QQQ returned about 55, 60%. So you would have been on the losing end of that trade or losing end of that bargain, right? So that's one instance when there's a big macro shift you want to consider. If at all, you need to change your strategy slightly. So if you're putting everything that you put into investing every month, instead of putting everything into SPY, maybe you want to think about other things, right? Like the QQQ. The flip side, if the interest rates go up to perhaps manage inflation, which could happen in 2021, 22, who knows? That may cause these growth stocks to actually, fall back, and some of the other stocks, which is more the commodities-based stocks or the financial sector, to actually outperform. So in that case, you want to consider, again, instead of going 100% into SPY, probably you want to put some into something like an XLF, which is a financial vertical ETF, or an XLB for materials, etc., right? Or XLE for energy. So that's the second time that you want to consider maybe a different approach than the standard SPY. And then, from my perspective, my example, I kind of fell into it. Strangely enough, I got lucky, I think, last year. What happened is, I remember the date, if I remember correctly, it was March. I believe it was March, late March. I think it was March 27 or April 17. I can't remember exactly. But that's when I sold off everything that I had outside of QQQ and the NASDAQ related stocks. I sold everything, took a big loss, sold everything, and moved all of it into Amazon. And I feel like that was a macro move I had to make. And I make a point about, getting your own conviction to make a trade or to put money into something. And I had very high conviction at that point that I sold everything, took the losses, and moved everything to Amazon. It paid handsomely for me last year. Now, you may or may not want to do that all the time, but you have to consider what's happening from a macro environment perspective, and thereby make some changes. Does that make sense?
Yeah, absolutely. You make an interesting point about it in terms of these macro shifts, because although it might not make sense on a day-to-day, month-to-month basis, it probably makes sense from a big pandemic impact or a big tech trend or a big, evolution of online services or whatever perspective. So, no, great point. And on a similar lines, I was curious to know, about the remaining 20% as well, right? So if you have, everything that's correlated to the stock market, when the stock market goes up, most investments which are correlated go up. And I was kind of thinking, what else is out there that's not quite correlated, either positively or negatively correlated, right? So, and the thought that came to my mind was, Bitcoin, after you mentioned it in your episode. So I was thinking, maybe it's time to take a look, or maybe a second look at Bitcoin a little bit more seriously. So I was just curious to know, what are your thoughts on it? where are we as compared to where we were maybe a couple of years back when it was still being frowned upon by many of the government agencies and so on.
Yeah.
Is that mainstream now in your mind? Is it something that's worthy of a look from an investor for a
Yeah. I mean, that's a great point, a great point, a great question. In general, this is I try to have some portion of the portfolio in some speculative positions, if you will, but not 20%, right? No more than five, but more likely up to 3% of your
Hmm.
total investment. I try to have that in a speculative position. So I have about 2 to 3% in Bitcoin and Ethereum today, right? Now, what is Bitcoin? Is essentially a file, a computer file that's stored that is in the Bitcoin believers' minds. It's either for two purposes, right? One is a store of value, like gold, and the other as a currency. Now, as a currency, I think it's far from being close to being a currency because of the volatility.
Mhm.
I feel like it has generated some momentum for being a store of value, and it has become a bit more mainstream. Right? Last time Bitcoin was on a tear was, around Thanksgiving in December of 2017. That's when it hit 22,000, $20,000, and then it tanked, right? But what's happened is that it's more recently it's gotten a bit more mainstream acceptance. Some of the big names that have been actually bought Bitcoin is one of them is Paul Tudor Jones. I mean, he's been around for a while, and he's considered a pretty smart investor. So he has got some, and then there have been some companies like MicroStrategy have now essentially denominated their entire balance sheet in Bitcoin. So instead of holding their working capital or in cash, saying they're holding it in Bitcoin, and turning themselves more into a cryptocurrency play than what their core business was before that. So I mean, the challenge is that, so what do you do, right? If you buy something like that, are you going to sell it off and after a 50 or 100% return? I don't think so. I mean, since I bought it, uh, Bitcoin is up 300% since I bought it. Sorry, three times, right? So I bought it about $10,000, and now it's up to $30,000, right? So, but I don't see the need to sell it today because that's not the return that I'm looking for here from a speculative bet. To me, is an order of magnitude that it needs to get to from an adoption standpoint, and from a volatility standpoint, it needs to come back down, right?
Hmm.
And that's when it'll get to not just three times, but 30 times or 100 times, right? That's the potential if that actually happens. I think there are a couple of big risks to this, right? The biggest one is that the governments, because they feel like it's a threat to their currency, they outlaw it, just downright outlaw it. Then what are you going to do, right? So that's a big risk. Or on the second, the second aspect is maybe they just create their own digital currency. You already have a digital yuan today. What if they create a digital dollar in the future, and just that digital dollar replaces the need for to have Bitcoin? Now, part of the reason the Bitcoin proponents like Bitcoin is that it's decentralized and it's independent of a bank or a government or the Fed. Now, that's also, it's a double-edged sword. That's an attractive proposition for many, but for governments, that may be the biggest threat. So we don't know how this is all going to play out. So either of those, right? It'll depend. So I'm holding on to that position for now. But we'll see if it goes to 10 or 30 times or 50 times in the future.
That's cool. That's cool. No, I think it's an interesting perspective, and like you said, it's highly speculative in nature. So it's interesting to see something so disruptive enter a market that is over decades has been evolving in a certain pace,
Yeah.
and you see a disruptor like Bitcoin just disrupting the fundamental of our currency valuation process. So
That was the markets portion of our discussion between me and Amol. We wanted to have this format to keep with our original objective for the show, which is to answer questions from people like us who may not have access to experts, or for that matter, write into CNBC and never hear back, etc. Hope you found this particular episode helpful. Please let us know in the comments section, and we can have similar episodes in the future depending on your feedback. For the time being, we will be finishing the malts and the machines parts of our discussion in upcoming episodes. Have a great week, and we'll talk to you soon.